Is the crypto market's latest drop giving you whiplash? You're not alone. The reasons for this brutal market correction are all over the place. Some analysts point to slowing Bitcoin ETF inflows and MicroStrategy pumping the brakes on its BTC buys. But while everyone's distracted by the dip, are we missing the bigger picture? Lark Davis says the market is ignoring some of the most insane news we've ever had, like the SEC backing off Ethereum and major crypto-friendly bills moving forward. Meanwhile, channels like The Modern Investor are yelling from the rooftops about a planned US dollar collapse, calling this a massive wealth transfer where giants like BlackRock are snatching up all the valuable assets. So which is it? Are you prepared for what comes next? In the latest video from Crypto Rover, he breaks down Bitcoin's current choppy price action. He explains that Bitcoin is testing the lower support of a bull flag pattern after grabbing some liquidity below, just as he predicted. While a bounce is likely because most of the liquidity is sitting above the current price, he also points out why we're seeing this dip. The drop is tied to a slowdown in Bitcoin ETF inflows for August and a downturn in the Nasdaq. It's interesting that he points to slowing ETF flows as a reason for the current price dip. That observation holds up. Recent data does show net outflows for spot Bitcoin ETFs after a very strong July, which certainly puts a damper on upward momentum. The market does feel like it's holding its breath, and his focus on the ETH Bitcoin chart is spot on. That pair has been stuck for a while, and a decisive move there could absolutely dictate market direction for altcoins. However, the influence of the wider economy can't be ignored. Decisions on interest rates and inflation reports seem to be having just as much, if not more, of an impact than crypto-specific news right now. The market seems to be waiting for a clear signal, either from a major crypto breakout or a shift in the global economy. In the latest video from the Crypto Tips channel, the host tells viewers not to panic about the current market dip, framing it as a minor issue compared to the massive, ongoing devaluation of the US dollar. He argues that government actions, not market forces, are the real story. He points to historical data, showing how a family home that cost $66,000 in 1981 would be astronomically more expensive today, not because the house is more valuable, but because the dollar's purchasing power has been destroyed. The national debt has also exploded from $900 billion in 1981 to over $37 trillion today, fueling this problem. It's a compelling point to connect the nonstop money printing directly to Bitcoin's value proposition. The numbers the video uses are startling but accurate. The U.S. national debt and money supply have indeed grown at an incredible rate. My own view is that while this inflation hedge narrative is a powerful driver for Bitcoin, it's not the only thing going on. The recent approval of spot Bitcoin ETFs has brought in a wave of institutional money that's less about escaping the dollar and more about portfolio diversification and speculation. This new layer of Wall Street involvement adds a different dynamic to the market that wasn't as present in past cycles. So, while the video's core argument about currency debasement is solid, the current market is also being shaped by these newer, more traditional financial forces. In the latest video from Lark Davis, he talks about why the crypto market is down despite some of the most insane news ever. He believes the market is overreacting to Donald Trump's new tariffs, something he says everyone should have seen coming. While the S&P 500 futures are down about 1%, he points to the strong U.S. economy, with 3% GDP growth in Q2 and massive investments in AI by companies like Meta and Microsoft as signs of underlying strength. Lark's take on the disconnect between the positive regulatory news and the negative price action is pretty sharp. It really does feel like the market is fixated on short-term macro fears while ignoring a fundamental change happening under the surface. The political tide in the U.S. is clearly turning in favor of crypto. The House passing the FIT21 bill was a major signal, and the SEC recently dropping its investigation into Ethereum's status as a security confirms this softer approach. This isn't just talk, it's a real shift that could reshape the entire industry in the U.S. The progress on a Solana ETF is another piece of this puzzle. It seems the market is currently pricing in fear, but the foundation for a much more welcoming and defined crypto environment is being built right now. It makes the current price dip feel more like a temporary distraction than a long-term trend. In the latest video from Ben Callen, he breaks down the crypto market's valuation using his logarithmic regression model. As of early August, the model suggests a fair value for the entire crypto market at around $4.137 trillion. The actual market cap is sitting at $3.782 trillion, which means it's currently undervalued by about 8.58%. He points out this isn't unusual, drawing parallels to the 2015 to 2016 cycle where the market hovered around its fair value for a long time. Ben's point about blue chip dominance really clicks with what's happening in the broader market. The entire narrative this year has been driven by institutional-grade assets, starting with the Bitcoin ETFs. Now, all eyes are on the upcoming launch of Ethereum ETFs. It makes complete sense that liquidity is concentrating in Bitcoin and ETH, as they are the main gateways for big money to enter the space. His idea that the broader altcoin market needs to join the party for a true parabolic run feels right. We often see capital flow from Bitcoin to Ethereum and then down into higher-risk altcoins. It seems we're still very much in the first two stages of that potential cycle. The market might just be waiting for the Ethereum ETFs to go live before the next major leg up begins, which could reinforce this blue chip phase for a few more months. In the latest video from the Coin Bureau channel, Nick breaks down a recent report from Iraqi's Finance that analyzes why so many hype token launches from early 2024 ended up flopping. The report looked at 10 major launches, and surprisingly, 6 of them were trading below their launch price by the end of May. Big names and blue chip backing didn't guarantee success, with tokens like Berachain's Bera dropping a staggering 74%. The video's analysis feels especially relevant right now. The market sentiment has clearly shifted away from the buy anything that moves attitude of past bull runs. We're seeing this play out with several recent, highly anticipated airdrops and launches that experienced significant sell-offs almost immediately. The frustration around high valuations at launch, which makes everyday users feel like they're just cash-out opportunities for venture capitalists, is a constant theme in online discussions. The point about product-market fit being the ultimate trump card, as seen with Kaio's AI narrative, seems spot on. Projects with a clear use case or a story that captures the market's imagination can defy poor launch conditions, while projects coasting on brand hype alone are getting punished severely. It suggests the market is maturing, demanding more than just a famous name and a big marketing budget. In the latest video from Crypto Banter, Ran and his guests, Avi and Santiago, discuss a brutal market correction that saw Bitcoin drop to around $114,000. They point to 2 main reasons for the dip. The first is new tariffs from the Trump administration, which the host believes is a short-term negotiation tactic and not a serious concern. The second, more significant reason is that MicroStrategy announced it will no longer issue common stock to buy Bitcoin unless its shares trade at a premium of over 2 times its net asset value, NAV. This news has the market worried, as it could remove a massive $600 million weekly buyer from the equation. It's interesting to hear seasoned investors like Santi and Abby openly admit that fundamentals are taking a backseat to memetics and narrative. The discussion around Ripple really drives this home. For years, the core crypto community has dismissed it, yet it consistently remains in the conversation with banks and regulators. This suggests the next wave of money might not care about decentralization, but will simply buy the names they recognize, which puts Ripple in a surprisingly strong position. In the latest video from The Modern Investor, the host argues that we're watching the collapse of the US dollar in real time, and it's directly fueling the rise of Bitcoin and the broader crypto market. He points out that the dollar has lost about 15% of its value in just 20 weeks, creating a massive push for investors and large corporations to move their money into other assets. This has led to some wild predictions, with one analyst forecasting XRP could hit $13 in the next 40 days, while others see Bitcoin going to $500,000 or even $1 million this year. The analyst Jason Pizzino is mentioned, who believes the dollar will keep falling as Bitcoin continues to climb. A big part of this is the potential for the US to slash interest rates by 2 to 3% in one go, a move that would totally wreck the dollar and cause massive inflation, leading to things like $70 eggs. The host says this isn't an accident, it's a planned wealth transfer. He points to companies like BlackRock and Blackstone using algorithms like Aladdin to buy up huge amounts of Bitcoin and real estate. effectively cornering the market on valuable assets before the average person can. The video ends on the note that people in crypto are set to become the richest on the planet, with future targets like a $1 million Bitcoin and $123,000 Ether. The video presents a very dramatic scenario, but it taps into some real and growing anxieties. The concern over the US dollar's long-term stability isn't just a fringe idea. It's a conversation happening in mainstream finance, especially with the rise of economic blocs like BRICS looking for alternatives. The host's point about corporate landlords like Blackstone buying up thousands of homes is also a documented trend that has had a tangible and often negative impact on housing affordability for everyday people. When you connect that behavior to the aggressive institutional buying of Bitcoin through new ETFs, it's easy to see why the great wealth transfer narrative is so compelling. While the price predictions mentioned are on the extreme end of optimistic, the underlying trends of currency devaluation and large-scale asset accumulation by the wealthy are very real.